All right, and it is 1 o'clock, so we can actually get started. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar website of promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profits. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific date or specific or identified date. Your results may vary. By accessing this webinar, you agree to hold yourself harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right. Business taken care of. Fantastic. Where are we then? Let me see. See if anybody's online. Don Tucker says, I can see. It's a miracle. Don can see. All right. Put that on my resume. How many miracles do I need to get sanctified by the Pope or whatever it is? I need 2 more miracles, I think, and I'm good. All right. Technical Tuesday, failure of the 50-day EMA. Yes, here we are. Okay. As you may have noticed, I tend to write predictive headlines. And when they work out, I look clever, so I enjoy that. We expected it to fail the 50-day moving average. It did fail. It failed actually ahead of the 50-day moving average on the S&P. And where's my little S&P charts? Not those, not those. None of these. We're kidding? Okay. Let's go to FinViz. These are my favorite current charts. And 5 minutes. I'm not going to get into it. We did this last week, so I'm going to get too into it. But what is this? Is that all we're up to? Oh, wow. It looks really ugly on a 5-minute chart, doesn't it? Okay, so yesterday we made it up to 1980. And this morning, then we fell back. And then we fell back to 1980. Now back to 1964. So we're channeling here, but when you look at it, you zoom out a little bit. It actually looks better when you zoom out. It looks like we're just kind of consolidating. And we are. We're kind of consolidating, trying to break over 1980, but we're not doing a good job of it. And if we start failing here, we're going to go right back into this zone. And now if you zoom out again, see, it's funny. So if you're in the 5-minute view, it looks terrible. You go to the hourly view, it doesn't look so bad. But then when you go to the daily view, you're not looking good again. Now it's looking kind of weak, right? I think in the weekly view might look okay. See, in the weekly view, it's just the whole thing's just a mild pullback, though. And look at this. See this pullback here? What do you have? Sharp drop off, little spiky guy, wiggle, 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 and then back down here, but it's a head fake, and then we go up, 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 up. So this is what the bulls are hoping for. They're hoping we're going to kind of repeat this pattern. But my attitude is, and again with the cash thing, right? My attitude is, even if we go up, 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 see what happened here anyway? We're right back to where we were over here. So what do I, why am I going to waste my time? All right, let's see what happens. But I'm not going to be excited until we get over that 2,000 line. That's what matters. In this case, see here, it was a 1,200 line that you couldn't get over. And then you fail and you pop back down. When you're over it and then it holds the next time, that's when you know you've got something going on. All right. Meanwhile, though, let me take a quick look at the chart and see how we're doing in the live chart. Yeah, see, none of this is very exciting. So, meanwhile, though, Our portfolios are popping, so what do we care? We have, this is a 5% portfolio, the options opportunity portfolio, which I just reviewed last night because I wanted to make sure everybody understood what our positions were here. A very important thing, if you're trading this kind of stuff and you're following it, right? At PSW, for the most part, nobody cares whether we win or lose $15,000. It's not making or breaking anybody's week or anything like that. But if you're a smaller investor and $15,000 is a lot of money to you, and we made $15,000 in 2 months, then for God's sake, take it off the table. Okay? When you went into the thing, you were looking to risk a little bit of money, and then now it's up $15,000. And if $15,000 is like, 10% of your total money, or 15% of your total money, that's a lot of money. Okay, you can't expect that to be normal. I would say there's barely a 50% chance that we'll make $5,000 more before we lose $5,000. So if $5,000 matters to you, take this money off the table. Not only that, though, but you get all bad prices from the broker. So if you do cash these out, you'll actually get more money because all these bids and asks are terrible prices generally. So this could be $17,000, $18,000 in profit by the time you cash it out. If that matters to you, you got to take the money. I mean, you can't get greedy and say, "Oh, look how much we made." We made a ridiculous amount of money. And I know that we intended to make a ridiculous amount of money. We intended to make 5% a month. This is 7.5% per month. This is 50% more than we were trying to make. We're a month ahead of the game already. So if cashing this out means that you can go and have a really good Christmas and take your family somewhere cool and do some great stuff and buy gifts or pay off some debt, for God's sake, why would you gamble with it? All right, this is a big thing that people. This is why I stopped doing the $25,000 portfolio, because people kept following it who couldn't afford to lose $25,000, and I'm like, I don't want to do that. It's too dangerous. Okay, that's not the way you play options. When you only have $20,000, when people ask me what should I do, they say I have $50,000, I have $25,000 to invest, and they say, well, what should I invest in? And I'm like, invest in a job. Go work. Okay, because if you can sit here at a computer watching the market all day long, and you've got $50,000 to your name to invest in, then you should damn well be out there earning some money. That's my best investment advice. Leave the money alone, put it in something very, very safe, let it accumulate 5% a year or whatever, and you go out and you earn $10,000 more to add to it, or $20,000 more to add to it. Don't make it your money's responsibility to make more money while you sit there. Okay? If you're comfortably retired, you have a lot of money to play with, so on and so forth, then you can have fun. But if you're in your working years and you're able to go out there and earn $25,000, $50,000, whatever, and you're going to sit there instead and say, I've got to take this money that I have invested and I've got to make $50,000 so I can, instead of working, that's crazy. Because you're risking the money, for one thing, that you need for your retirement. Even when you make money, you're going to spend the money that you make, and you're going to net nothing. So in other words, let's say you have $1 million, and you need $100,000 a year to live on, right? And you have the ability to work. You're constantly going to be trying to make 10%. Right, with your $1 million. And that sounds pretty good, and you can. I'm not saying you can't. But you're going to constantly try to make 10%, right? So you're going to make 10%, but if you keep spending the money that you make, you're never going to grow your $1 million. And after a while, there'll be inflation and so on and so forth, and now 10% won't do it for you anymore. That's problem number one. Problem number two is everybody has a bad year. All strategies fail over time. Okay, so at some point, the market won't do what you think. It'll go the wrong way. There'll be a crash, whatever the hell happens, and you'll lose 10%. Then you only have $900,000. And still, if you're living on it, now you've got $900,000. You can't quite get $100,000 to live on if you make 10%. And not only that, though, but every time you make another 90, you're spending that. So then another 5 or 6 years go by, and then another black swan hits you, and now you're down to $800,000. That's not a plan. You have to make sure that you're living a lifestyle inside of the money that you're making in the markets that's lower, that you're saving. I would say, frankly, you should be saving at least half of whatever you make. And if you can work, you should work. Imagine if you're making $1 million a year. I'll show you. Wait, that's good. I can show you. Watch. I'm going to show you something important. And I did a whole article on this not too long ago. I forgot what the name was, but okay. So let's just take a quick look. I want to show you by example. I mention this all the time. I'm not sure how many people actually use it when I link to it, but it's really good to play with so you can get an idea of what your financial position would be. So if you have, let's say you're $1 million's a lot. So let's say you have $500,000 in the bank and you're 50 years old. Okay, you have $500,000 put aside. Now, let's say that you're capable of making 12% a year. All right, that's going to be $60,000 a year. Now, if you are trying to sit there and make a living out of trading the market, and you're living off $60,000 a year that you make in market income, you're not growing your $500,000. And if you're 50 now, instead of growing it at 12% for 15 years, so in other words, what you should be doing is going out there and having a job that covers what you're living on, and then for 15 years you're going to grow $500,000 at 12%, and then it turns into $2.7 million at 12% a year. So in other words, for 15 years, your plan is to spend 15 times 60 is 900,000. I know that. 15 times 60. So your plan is to spend $900,000 of your on your $500,000. It seems pretty good. You're making good money, but the thing is that instead of doing that, you could be out there earning $60,000 for the 15 years. And I know who wants to work for 15 years when you don't have to, but you have to. You got to be realistic about your life. And then at 12%, if you make the same 12% annually and keep putting that money back in, instead of having $500,000 when you're 65, you'll have $2.7 million. And then 10% of that is going to be $250,000 a year. Half of what you have now would be your annual income. And it doesn't matter if this number, it's the same math. If this number is 100,000, it's going to be the same math in the end. It'll just be lower, of course, but I mean, it's the same concept. Now, 10% of this number is 50,000. It's half your income. That's in 15 years of compounding the interest. So I don't care how old you are, how young you are, you really have to think about it in these terms and say, if you're not reinvesting the money you make, you're just sort of like constantly walking on a tightrope where any slip is going to hurt you really badly. So keep that in mind. And that goes for all of our portfolios. But when you have a fantastic run in a portfolio, you can cash it out. It's not like we're going to make more trades. But when you make this much money, if it matters to you, cash it out. And I said this about our other portfolios too, okay? So we have our long-term portfolio. This is where the bulk of our money goes, is into our long-term portfolios. Nice, slow, steady positions. But even this is pretty volatile. I mean, now it's incredible. Now it's up 42. We haven't touched this thing. It's at 42.6%. That's going to be some ridiculous amount of money. $713,000. It's up 42.6%. This is up like $50,000 since last week. Because, and here's why. You see this negative 156? We have a ton of cash, $869,000 in cash. All these negatives are because we have all these short puts Look at all these. 25 short puts. So these are places where we're looking to establish positions with short puts. And we have all of this incredible, and so there's so much money where we've sold, so we sell these positions, we collect the cash, so we have the cash in our portfolio, but we're charged a huge negative on their value. And what's happened is they've dropped $50,000 in value because as the market goes up, they drop in price. And don't forget, these are self-hedging positions. So our worst case is we buy the stock cheaply, which is what we kind of want to do in the long-term portfolio. These are stocks we already bought cheaply. All these ones here, these are our actual positions, and there's only 18 of them. These are our actual positions, and these are the stocks that we were forced to buy cheaply. So all these entries are pretty good prices generally. And you see a lot more green. See, here's like mostly green, green, green. That's not very good. But green, you got a lot of green in there. Even though, and again, these are all our losers, by the way. We sold our winners. We cashed in our winners a while ago. So these are all our losing positions that we're still working on. These were not losing positions particularly. These are just all stocks we still want to buy if the market got cheaper. It hasn't gotten cheaper enough for us to buy any of them, so we just end up keeping the money. But anyway, again, 42%, huge money. This is what we intend to make, though, annually. We're almost into year 2 here. We started in Thanksgiving of 2013. So we're getting into year 2 here. This is right on track for what we hope to make, is about 20% a year. 15 to 20% a year is our goal. Now, the real outlier, though, and we already have cashed it, is the short-term portfolio, because this has already been cashed out because we made so much frickin' money. This guy's up 268%, just because we just so happen to have really good, well, aside from having really good time, we had a couple of plays that just paid us a fortune, like Netflix, which was painful at first, turned out to be a huge winner. We played oil short all last year, huge winner. We nailed a couple of turns in the market for huge winners. There's a bunch of things that paid us just gobs of money. Apple was a huge winner. It was our stock of the year, and we cashed it. So we just happen to have a collection of really good plays that we went on this. Generally, the purpose of the short-term portfolio is to protect the long-term portfolio. So that's why you see a hedge and a hedge and a hedge. And even FXT was a hedge, except that that's just a big winner now. When these expire, they'll be pretty good. SLW is an inflation hedge. GLL is an inflation hedge. TZA. Oh, are we still short those? Wait. Oh, it didn't do the splitty thing. That's right. Okay. That's going to have to get adjusted at some point. And FAS was just a long play. Well, it's part of our past money play that we did. Oh, that one was a great play, too. This is just a leftover leg of it. Anyway, so all that's left in this portfolio are some hedges. So basically, this thing has been cashed out. Out of 368,000, it's 320,000 cashed. And again, because I don't care how rich you are, that's a lot of money. Okay, that started out as $100,000. Now it's $368,000. That's good money. And unless you're positive that you can do better, you cash it out. It's a no-brainer. So don't be confused by the total of the portfolio. It's the amount of money we were working on. We're working with $48,000 here. We're not working with the $320,000. And then last of all will be our butterfly portfolio, which is a self-hedging portfolio. And that's up 83%, which is fine because this is a much more conservative portfolio. That's up 83% and also with gobs and gobs of cash, but in this case we're using quite a bit of margin for it because we have mostly because it's Disney play. I mean, that's the optional play in this portfolio. We sold these Disney calls short, and we don't have any reason to take them off the table. You know, we dismantled the spread, but why would we take these off the table? Because if they expire worthless, we're going to pick up like $16,000. So that'll put us up 100% for the year. But anyway, so these are they're all complicated spreads. There's actually only 9 spreads. They just look like a lot of positions because they're all like 4-legged. All right, so let's see if anybody has any questions here before I move on. Here we go. Steve says no sound. Now Steve says okay. Mary says no sound, but she didn't say okay. Hopefully she got her sound. And James says, where do you keep your cash? We're in the broker, man. Just leave it with the broker. It's as safe as anywhere else. They have insurance. Make sure you, well, I say that, I wouldn't say that's a great. Make sure your broker has your money in an insured account. Don't just assume that it's covered if it's a large amount. You have to, once you get past $250,000, which is what the Fed covers, you really have to, make sure you understand how your broker's insuring your money, what kind of private insurance, who's backing it. Okay, if J.P. Morgan or Goldman Sachs are backing your money, that's okay, probably. But as you saw in the last crash, there was no surety at all. If you said, oh, my money's backed by Lehman Insurance, it's nothing. If your money was backed by AIG, that was nothing in the last crash. You have to understand what is the Fed rescued last time, because when they rescued the banks, people don't understand that now again, this is also, by the way, a favor for rich people, of course, because rich people have money in banks that are insured by Goldman Sachs and are insured by AIG or insured by J.P. Morgan, insured by Bear Stearns. Their money, Bear Stearns takes derivatives to ensure that, they take money and they own derivatives that insure your cash. That's why there's all these trillions and trillions of dollars of derivatives that everybody's so worried about, because realistically, there's no such thing. If all these banks actually crash and collapse, your money's not insured. Your money will disappear. That's what will happen to your money, because your money is what? It's paper. It never was money, was it? You got a piece of paper from your employee telling you there was some money. You gave that piece of paper to your bank, and now the bank tells you there's money, but there was no actual money. It's all just a big joke. That's unfortunately. Yeah, credit unions, but again, everything's just electronic bullshit, though. Honestly, it just doesn't matter. There's nothing to anything other than the faith and credit of the financial system. And again, I don't want to get into that now, because we're not in that kind of situation. I don't see that we would be. We almost were, though, in 2009, and you do have to give the Bernanke and the Fed credit, and Geithner credit, and everybody else who almost shot themselves in the head trying to fix this thing, because our financial system was collapsing. We almost went to like a barter economy. It was really close. I mean, things were just completely falling apart, and if we started having bank runs in the United States, the entire monetary system was going to collapse. Look, people don't realize. The average person doesn't, not even the average person, I mean, almost nobody understands what complete bullshit the monetary system is. That there's just nothing backing any of this stuff other than your faith and somebody else's faith and whatever, in the fact that when I write a piece of paper or a check that says $15, that ultimately somebody's going to, actually give you $15. But even those dollars are nothing. There's nothing backing those dollars, just your faith in the United States government to give you dollars. What can you trade those dollars for? You can only trade them for what somebody else is going to give you, willing to take those $15 for. That's it. There's no actual value to this stuff. Money is just a form of trade. And the government's job is to limit the supply of it and prevent the counterfeit of it so that it is a reliable form of trade. And Frank, now, I would argue that a share of a company is more valuable than money. Certain companies, anyway. But, if I own a share of IBM, if money collapses, somebody still needs, obviously, society devolves into some post-apocalyptic nightmare, but if money just happens to collapse for whatever reason, and people still need computers, and people still need to do business and conduct business internationally and stuff, then IBM still has a company. Okay, they may have to trade a mainframe computer for 150 cows or whatever, it may get weird, but the bottom line is somebody still needs their stuff. And that goes for, like, if you have Levi's, if you have this guy, even if you have a gold miner or whatever, at least they own a commodity. You own a piece of a company that owns a commodity. That's actually more valuable than owning a piece of government paper that says, where the government says, here's what it is. And you can see that from the way they devalue currency. our government, Japan, Europe, everybody's devaluing the crap out of their currency. So the money that you hold that you think is safe cash, it's not safe because the value of it goes down constantly. So, I would certainly argue that no, I don't like keeping money in the banks. I like keeping money in the stock market because as cash devalues, market prices go up because there's a finite amount of shares that you can trade your money for. Okay, and obviously companies can dilute their shares, but generally you own a piece of a company. You're an owner of this corporation. And therefore, you have, and as long as the United States government survives and protects your rights and so on and so forth, then you're going to be in good shape. And probably in much better shape than if the economy collapses. In other words, when Germany had hyperinflation in the 30s, and the money went completely out of control, and it was like $1 billion francs for local bread or whatever. If you own the bread company, though, you were fine. So what? They don't care. People paying them $1 billion francs for a loaf of bread. That's fine with that. They're getting paid whatever their bread is worth in barter. And barter being for money. You're bartering for the money. So owning companies is always better than having cash. Owning commodities, not so much. You're gambling on the commodity availability and so on and so forth, as we can see right now with a commodity collapse. Although obviously, again, from our long-term portfolio, this is another reason it's doing so well. Our long-term portfolio is basically, I'd say about a third of it must be material stocks. And why is that? And again, this is a very important concept in our system, that what do we do? When the market was up and I called for cash, we cashed out of all of our winning plays, which were the biotech plays and Apple and other tech stocks and things like that. All the stuff that was high, we got out of. And what do we do with ABX and BHI and Transocean and OIH and Seadrill and Silver Wheaton? What do we do with all these commodity companies? We pressed our bets. We took the cash from our winning trades that were well up in the cycle, and we pressed our bets on our losing trades in the commodity side of the cycle, and that's why we're doing so fantastically well. It's the same thing I'm telling you as I started this thing saying, we reinvested our profits into our underperforming stocks, the ones that we still believed in, of course. I mean, we dumped BTU, which frankly turned around also. But that's an outlier with BTU. See what they did. BTU just had a 20% jump today. In fact, they had several 20% jumps. I think I mentioned when they had a few 20% jumps before, I said, yeah, they just got to gain 20% like 15 times, and we'll get somewhere near there. We'll start getting back to like something. They're still in dire straits. They did a reverse split. That's why these numbers are so high. But today, look at that. 24% today. All right, but we gave up on them. That was one that didn't make the cut. We have some REITs here. These are the guys we pump more money into because we like them long-term. Here's Transocean, who's having a good day today, finally. Look at Transocean, actually in the money. God, I haven't been able to say that in years. Transocean is in the money. We doubled down on Transocean. We thought it would come back. We don't know when, but we figured eventually it will come back. So instead of dumping it when we closed our portfolio, we put more money into those kind of positions. Because we know the market is cyclical. And so, so at any given time, this is why you always want to diversify your portfolio. At some point, certain parts of our portfolio will do well, while other parts of our portfolio will not do well. What we do is when the parts that are doing well, we take the cash from that one that does well and we cash it out, and then we put it back in. The mistake people make when they diversify a portfolio is they diversify their portfolio and then they think they're going to keep the same stocks for like 20 years straight. That makes no sense because the whole rollover of cyclical stocks means that sometimes some will be doing well, sometimes others will be doing well, and you'll end up doing net zero because you're playing against yourself. That's not the point of diversification. The point of diversification is to be able to have winners and losers in any type of market, but if you don't cash the winners, what are you doing? You need to get into a stock and have a target, and when you hit your target, you get out. And that's another reason I love options, because you set a time frame and a target, and it enforces a discipline. If I'm, in other words, I say rig will be at 20 in January 2017. When rig is over 20 in January 2017 or sooner, basically what am I going to do? I'm going to cash that play out. If I want to play it again, I've got to really come up with a whole new play, and it forces me to reevaluate it. If I just had the stock, it would have gone from 15 to 20, and I say, oh, gee, do I really want to sell it? It's been doing so good. Oh, I like it. I don't want to do this. This is what happens to people who have stocks. There's no timer on the stock. There's no target on the stock. You just own it, and you say, ooh, that was doing really well. My brother, I wanted to strangle him because he had Apple since it was 70. And at 130, I was like telling him, sell, sell, sell. 130, 125, 120, 115. I kept telling him, sell, 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 sell. I said, so I'm saying to him, sell because I can get you back into Apple for way cheaper than that by selling some damn puts. You're not missing anything. I kept trying to explain this to him. I'm like, you're not going to miss anything. You're going to sell the stock for $130. You're going to sell the $100 puts for $20, and then you're going to come back in at $80 or something like that, or whatever it was at the time. I said, so your worst case is you come back in at 80. Meanwhile, you sold the stock for $130 plus puts for $20, and that means you got $150 in your pocket. You're not going to do better than that. And I said that to our members here, which is why we cashed out. That's why we cashed out of Apple. And do we have the Apple anything? No, we don't even have any Apples because we offered to get back in, but we didn't get our price yet. We have a standing offer to sell 10 Apple, I forget what they are, right? I think it's like 100 puts or something like, no, $90 puts. We offered to sell 10 2018 $90 puts for $15. So far, Apple hasn't gone low enough to fill that for us yet. I don't know if it ever will, but if it doesn't, I would rather chase them above 120 than try to guess whether or not they're going to stabilize here at 110-ish. But the point is, with my brother, he finally, after the first scare, when it came back a bit, he finally sold some. It was, it was a big part of his portfolio. It's not, it wasn't diversified. It was very Apple heavy, and he held it way, way too long because who wants to let go of such a good stock? Who wants to let go of a stock that doubled for it? But that's when you must let go. You have to have a realistic expectation of how much a stock is going to go up. And when you get into cash, then you've got more opportunities to do things. And then basically, I had to argue with everybody about going to cash earlier this year, and I was like, oh my God, it's like we're going to find more stocks to trade. And our portfolio performance since we cashed out has been way better because we got into cash and we got flexible and we made a bunch of new good decisions instead of just trying to beat the old tired horses that we already had. It's a very, very important thing about overall portfolio management. All right, let's see if anybody has a question. Oh, there we got some stuff. All right, credit union's nicer. Silver went over 16, is now back underneath. Would you be interested in shorting or stay away? No, I'm. That's another thing about the way I trade. I like silver when it was low. All right, we have long trades on silver still, but this is the chart that I look at when I'm making investments. I look at the weekly chart. I think that's weekly. Yeah, weekly. Anyway, so I look at a weekly chart. And so for me, yeah, 16, you know why silver got rejected at 16? Because 16 is the 200-day moving average. Probably up here you'll see it too. So here you go. 16 is the 200-day moving average. That's why it got rejected at 16. Not because it's going down, but because of course it's going to get rejected at 16 after going up from 14. Of course it is. That's like, whatever, it's 10, well, it's 1540. See 1544 here? 1540 off of 14 is a 10% run. You expect to see a pullback, let's see if we can see it over here. Okay. When you're at 14, 5% rule, folks, right? 10% run from 14 is 1544. Is 1540, sorry. Then you're going to get a pullback. In this case, we had a pullback. We got a bounce. Came a worse, now a bigger pullback, all the way back to 1450. A little spike down, but we ignore the spike down, so we held 1450. And then, boom, it rockets up to test the 200-day moving average. It'll probably now consolidate between 16 and 15 for a while, and then it's going to break higher. And it's going to break higher because there's so much freaking money in the world. There's lots and lots and lots and lots of pieces of paper that say they're worth, that say $1,000, $100, a million yen, whatever the hell they say, but there's not that much silver and there's not that much gold. We talked about this last week, so I'm not going to get into that again. See, I have flashbacks. I realized I talked about something already. But anyway, so the secret to my success is I have a long-range view of the markets. And my long-range view says we have printed we've added another 10, 15% to the money supply between here and here, and there's no way that this should be going down. And the same goes for gold. There's just no way that should be going down. So I'm bullish. And I wouldn't turn around and short until we're up around the high 20s. Maybe when we test 20, I might take a poke at a short. But really, my heart wouldn't be in it because I just think we're going to go up and up over time. So I'm basically just long on silver, and when I see a pullback, that's an opportunity to get in long. But I don't flip-flop my positions just to play like some short-term thing. When you're looking at the hourly chart or the daily chart, everything looks like an opportunity to go both ways. But the trend is your friend. The trend is going to be up. It's going to hit this resistance. That's normal. It's going to consolidate here, and it'll eventually pop over. So down here, as it consolidates, or if it tests 15 and forms a solid floor, I'll be real excited to go long again. That's much more exciting than trying to short the thing. Is TDA safe? No, I'm sorry, TDA is a huge bank. They have great resources. That's one of the reasons I do like them. Still, though, they then underwrite your deposits with other banks. So you have to if you have large amounts of money, you talk to your broker about, talk to your guy about what your account is insured by, and if there's extra insurance and what that would cost, and so on and so forth. Just make sure you're well insured in your accounts. Especially if you have like millions or whatever. Generally, they're safe. Nobody lost any money, even though Bear Stearns and Lehman collapsed. Nobody lost any money out of their accounts in the financial crisis, but they could have. Realistically, though, the government will just print money to cover you for the most part. That's the most likely scenario in a bank crisis, but then you're going to be sitting there with your money will be worth half of what it was. You'll get it back, but it'll be worth half of what it was because they printed the crap out of it. That's why you should always have like some gold or silver or something as a hedge. Now, again, I don't want to get into this doomsday crap because we're nowhere near that scenario. We almost hit it in 2009. We're miles away from it now. And not just because of the price of the market, just because the financial excesses of that time were so severe that they destabilized the world financial markets. Now that we're not in that position now. Okay, there's no more issue of that. There's nothing of that magnitude likely to occur. But meanwhile, you have to realize how many things were collapsing. So the brokers were collapsing. The banks didn't have adequate money to cover it. The FDIC didn't have anything near enough money to actually pay off the insurance. And then the funny thing about these ETFs and all these gold things is they don't actually have the gold. So you put your money into a gold ETF. It's not physical gold. They don't have the gold. If everybody tried to actually get the gold out of the ETF, it wouldn't be there. It's another notional value. They've got futures contracts. Those futures contracts are meaningless if everybody starts grabbing the physical gold. Gold, silver, anything. Doesn't matter what it is. Look, the whole thing is a house of cards built on the faith of the people participating in the system. That's just a fact. It's called a fiat currency system. You have to accept this fiction to play the game. Just like any game, right? You're playing Monopoly. You have to accept the fact that this is money and these are houses and those are hotels. It's all like that. There's really not that much different. So this is a game that we all are agreeing to play. It's a good game. It works well, and every powerful person in the world is heavily invested in it. So it's not likely to fall apart. Not likely, or they wouldn't let it fall apart too much if they can avoid it. And as we saw in 2009, the entire world. There's one thing the world agreed on: is we got to save this phony baloney system. So unless there's a severe catastrophe in which there's a reset on the planet, they're going to save this phony baloney system. Which was frankly my investing premise back in 2009 when everything was collapsing. I said, no, they're going to save this phony baloney system. In fact, I wrote an article that was called The Worst Case Scenario. I forget what it was. Right about that time, I wrote an article saying this is the worst case scenario. And I made a point that, look, you have a $100 trillion global GDP, and now the markets are down 50%, so you have a $50 trillion global GDP. And I said, that's not really true, though, because it's not possible, because when you have $50 trillion, which is what, 50,000 billion, right? So you have $50,000 billion divided by 7 billion people. That's only $7,000 a person of GDP. Currently, if you're reading this, your family and you are in the $50,000, $40,000 range of GDP. So, in what possible catastrophe is your lifestyle going to fall below that of one of those people in Africa who carries water from a well on their head? Even if everything got taken away from you tomorrow, and all your money was wiped away, but your debts would be wiped away too. So all your money is completely wiped out. What are you going to do? You're still going to get up and you're going to go to work, or you're going to do something to make some money or get some food or do something, and you're going to generate GDP. And it's going to be more than a subsistence farmer in Africa. So when the entire world GDP gets down to the level of subsistence farmers in Africa, that's a good time to go long in the market because it's not realistic. That's when you know you're in an unrealistic panic. When you do the math, which is exactly what we did in 2009. I just remember it's called The Worst Case Scenario. Let's see if I can find that. So I did all the math, so I won't get into it again. But stockwell.com, worst case scenario. The worst case scenario. There it is. June 2010. I don't know if I can put this into chat, but I'll try. Let's see what happens. So anyone was interested in reading it later. Oh yeah, that works. Okay. Anyway, so I did the math at the time, and the GDP was different. The numbers were different. In fact, there it is. I wrote 10,500 at the time. Where was that thing? Oh yeah. Anyway, so I did the math, and I said, look, you have to buy at this level because we're now pricing the entire world economy at a ridiculously low price. And that exactly what I'm saying today is what I said back then, which is, 5 years ago or so. So exactly what I'm saying today is exactly what I said back then. And I said that was just an article I wrote. I've been saying in chat, obviously, for a while. But the point is, there are limits. And this is what I was talking about today also in my article today. I was saying, you listen to people's opinions. And all these guys on TV will tell you, they come on TV and they say, I think this and I think that and blah, 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 blah. But meanwhile, some people are just freaking wrong. And their opinion isn't valid. I don't care who they are. I don't care how famous they are. I don't care how smart they're supposed to be. If you're wrong, you're wrong. And there were thousands of people telling you that the world economy was going to get much worse back in 2009 and 2010. We're telling you how your money would be worthless and the banks would collapse and blah, 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 blah. And everyone was, and they caused a panic. And I just sat there and I did the math. So I got sick of it. So I wrote that article. So I got sick of it. So I did the math. And I said, look, this isn't how it works. It's like saying, look, water boils at 100 centigrade and it freezes at 0 centigrade. These are facts. They're not up for debate. They're not up for dispute. And then that's also very important in my investing premises. Same with silver. Silver doesn't go below this line. Not without a panic. And if there's a panic, then you just buy more. Same goes for gold. When we put a floor on gold, you know what our floor on gold is? The extraction cost of gold. That's our floor on oil too. Our floor on oil is the extraction cost of oil. Oil is basically cost about 40. You can extract oil for $20-something in some places, but the average price to extract oil out of the ground around the world is $40. Okay, to extract enough oil for us to use. So in other words, you don't need gold as much with some gold. You need some gold, you need some silver for industrial, but you don't need gold and silver so much like you need oil. We need 80 million barrels of oil a day minimum to run our global economy. We need it. We cannot function without 80 million barrels of oil a day at the moment. The average cost of pulling 80 million barrels of oil a day out of the ground is about $40. Therefore, when oil gets to $40, we call that a floor. It could go lower because people can stupidly price it lower. But that doesn't mean it's going to stay lower. And that means that when it goes lower, if we're wrong at $40, we're not going to get out of our trade and say, oh my God, we were wrong, it's going to be 20. No. If it's 20, we'll double down and average at 30. And if it goes lower than that, we'll double down again and average at 20 because, goddamn it can't stay there. It physically can't. It's a fact. Because at $20 a barrel, there's only a certain amount of time before people who are currently producing oil have to stop. You know, if you perform any function that you perform in your job or whatever, if you perform it and you're losing money performing it, at a certain point, you might think it's a cycle, and you might think it'll change, and you say, oh, well, I'll keep doing it for now, and then the money will come back. But after a while, you have to stop if you're not making any money. Everybody runs out eventually. Even the Arabs are going to run out eventually and can't keep making oil for less money than it costs them to make it. Can't keep selling it for less than it costs them to make it. So that's the way I look at the world. I look at the world as like there's absolute values to things. And I am a value investor, but I look at everything that way. I look at the whole market that way. I look at the globe that way. I look at the way when I look at the political candidates, I look at the value of their tax plans and I look at the math of what they're talking about, where it's going to lead us. Some things work and some things don't. And it's not, to me, it certainly is not subject to somebody's opinion. They're facts. And you can't change the facts by talking them to death. So Pat says, it looks like oil is breaking down. Is it a short? It is a short. We quartered a short at 49. I'm not sure what it hit. 48.63. So it's going to be a better short next week because the contracts run out. Where are we? Where are we? Blah, blah, blah. So the 25th, it's 3 business days before the 25th. So the 25th is Sunday. So business day, business day, business day. So either the 20th or the 21st, this is the part I can never remember, either the 20th or the 21st is going to be the last day for oil trading. We're at the 6th. They can probably skate through this week without too much problem, but starting Monday, there's a lot of pressure to get rid of all those excess barrels of oil that are basically fake orders on the NYMEX. And that's when there's going to be a lot of pressure this month because they're trading, I would tell you if I could remember. Hang on, let me look. They're trading November barrels now, so they have to roll those barrels to December. But December is already stuffed with 300,000 contracts for 300 million barrels of oil. Nobody wants 300 million barrels of actual oil in December. They really want about 10 million barrels of actual oil. We have 290 million of fake orders. There's currently 424 million barrels to order in November. So between now and the 22nd, so in the next 15 days, they have to get rid of at least 400 million barrels of oil in 15 days. So that's like 23 million barrels a day have to be pushed into the other months. But the problem is November is already stuffed full of barrels. And January's already got 124 million barrels. So this is a lot. So if you add them up, and I'm just looking at it here, it's 3 plus 4 is 7 plus 124 in January is well over 800 million barrels of oil are on pretend order between now and January. It's ridiculous. That's way too high, and there's going to be a lot of downward pressure on oil from the contract rollovers, despite whatever OPEC does. But that won't stop it from shooting up because OPEC has a meeting in November, and they'll talk up the price, and that's what everybody's counting on. That's why there's so many open barrels now. Everybody's praying that OPEC is going to come in and save them and start talking about curtailing production. So that's the only way they're going to get prices up is to curtail production because demand is not coming back. Mary, what's your upside target for Hub, and where can we cash out on the O portfolio? Do we have Hub in that portfolio? I don't remember that. Maybe we do. I got a lot of stuff, so it's hard to remember. Oh, we do. Okay, good. That's good. I love it. Well, first of all, see this 2017? It's a 2017 trade, and it's an aggressive one. Oh, no, it's not. I'm sorry. It's not. It's a bull call spread. This is a trade that really you're not going to get out of until 2017. This is a trade designed to say that Vanadium will be over 250 in January 2017. We spent 2,000 minus 800 minus 800. We spent $400 net on this spread, and if it pays off, it's going to pay us back $2,000 off of 400, which is a gain of $1,600 bucks. It's 400% upside on that trade. But unfortunately, to make 400%, you kind of have to wait the whole year. And I know that's sad because, probably you usually make more than 400% a year, but that's the way that particular trade works. If you didn't get into that, then you have a $1,200 trade that's going to go to $2,000. You'll make $800, which is 66% in the year. That's still not bad. I wouldn't worry about it. Do you think the Fed will do more QE? Well, first of all, the Fed has no interest at all in helping emerging markets. That's got nothing to do with this. They've got to help themselves. We only care about whether or not the emerging market's going to spill over and hurt us. Do I think the Fed will do more QE? No, I don't. I think their balance sheet is maxed out. I think that they have to start tightening. They don't have a choice. They will have no credibility if they don't. And so eventually they have to tighten. I really think they still have to tighten in October. I'm the only person who still thinks that. But I really don't see how they're going to go past this meeting in October without tightening. Oh, by the way, Draghi was supposed to have said something. He should have spoken like right about now. He obviously didn't help the markets any. Draghi had a 1:30 thing scheduled. So if he didn't ease any, then we're not going to ease any. And we're not going to ease any anyway because it's just ridiculous. You can't do it. It's not working anyway. You can't just keep doing what's not working, and that's your solution. What has to be done really is the Fed has to basically put more pressure on Congress and say, you've got to do stimulus. You've got to do real stimulus where you create jobs and build things. That's what we need. We need real stimulus that puts people to work, not this BS where you hand more free money to the banks. What's my opinion on SLW? We have SLW. That's one of our trades in the short-term portfolio, so I definitely do like them. Obviously, they're up a bit now, but we have a very aggressive play on that in the short-term portfolio. Oh yeah, look at that, nice. So I'm very glad that we have an aggressive play. We'll probably ride them out to here and take the money. It's an open thing that we have. It's what is it? Oh, which one's this? We don't have it in this one. SLW. There it is. We have the January 15 calls. Oh no, we have a spread. I'm sorry, my mistake. We have this January, so I targeted 18 for this January, and we sold the 18 put, so it's very, very aggressive. It's currently way behind, but that's our target. We took the 18 puts, we sold those, and we bought the 15-18 bull call spread, and we did evens on all of them. And I think it's a long-term portfolio. We have a different one. And oh, that's not it. And currently, SLW is at 14. So this is my target for January. It was up here. We'll see what happens. What do you see the range of the S&P at the end of the year? Well, we haven't changed our big chart. Our big chart, not that one, wrong week. Here's that big chart. Not as big as it could be. Open a new tab. Open a new tab. There it is. There. Now it's big. Our goal for the S&P at the end of this year is 1850. Oh dear. Anyway, so our must hold line is 1850. We think it should be in around this range between 1850 and 1940. Probably not 10% up. So right around in this range, around 1950-ish, would be about the most I think it's going to finish the year at. See the 50-day moving average is coming down? If they don't crack this 50-day moving average, if they're rejected here, the 200-day moving average is going to come down below 2050. It's going to hit the 2035 line. That means we can't possibly be up 10% by the end of the year, and we'll get more and more pressure to the downside as things go, and we'll start probably forming a range that sort of heads down. So if you give it 3 months, how much is a month? That's a month. So figure here, rejected to here, you come back here, but then you hit the 50 again, and then to here. So you're right around there. Yeah, you're right around 1850, 1942 range for the end of the year. That's why we've had no reason to change those lines. Those lines have been there since like the end of 2012, I think, or 2013, something like that. They're very old lines, put it that way. And that's where we are. So no surprises and nothing going on. I mean, there's certainly not. I'm worried about it going lower. I'm not worried about it going higher. I'm worried about it going lower because the earnings are going to be a disappointment, which I also talked about in this morning's post. Have you looked at the DAX? It looks like it may be able to maybe dumping again. That's very another thing we're certainly worried about. In fact, I mentioned that this morning because I said, look, wait, that's the DAX? Why does it look so weird? Oh, because we're in the weeks. Man, what a difference a view makes, right? So this morning, this is what we were looking at. We were looking at the DAX. I said, look, it's not going to make it over 10,000. So since the DAX wasn't going to make it over 10,000, then we know that everybody else is going to get rejected too. And that's what happened. So right around the same time, everybody fails. And these are the DAX futures, so they're still going, I think. Let me see, hourly. Yeah, the DAX futures is still going. So Draghi did his little speech, and I don't know what he ended up saying. Let's see. Draghi news. Draghi doesn't talk about policy. What a bastard. Doesn't mention the economy or his outlook in his speech. Wow, that's so disappointing. Oh, forget it. We're going down. Okay, so whatever it was, he didn't say anything that was helpful, and he didn't promise any free money, and he didn't guarantee the economy or anything like that. He didn't do anything to help anybody, the economy in this speech. And again, because they are just as out of ammunition as the Fed is. All these central banks are generally out of ammunition, and here's again, this is why I like gold and silver. The only way that they can do anything else as far as pushing stimulus or whatever is to print much, much more money, huge amounts of money, because the amount of money it takes to save a $100 trillion market is twice as much money as it took to save a $50 trillion market. And at a certain point, you've got to understand, you don't save a $100 trillion market. It's at $100 trillion. It doesn't need saving. If it goes to $80 trillion, which is 20% below where we are now, it still doesn't need saving. It's the $50 trillion market that needed saving. And if you keep saving the market, if you keep acting like you have to lock in every double the market makes, then the central banks will just go infinitely in debt. That's not the way it works. There needs to be an allowance for natural growth in the economy. There needs to be an increase of goods and services and an increase in commerce and increases in efficiency that allow the economy to grow in real terms. You can't just keep faking it. And then when you get your fake gains, you can't lock in your fake gains. It's ridiculous. And it's funny because the Republicans will sit there and talk about how people get used to these entitlements and how bad it is, but meanwhile the investing class is completely entitled. People think that you're just supposed to keep printing money and the Fed is supposed to constantly bail you out so that no possible way can your investments go down. Markets go up and markets go down. There are cycles. There are good times and bad times to invest in the economy. There are good times and bad times to invest in companies. You can paper over, I wish I had economic cycle. There you go. Economic cycle. Great, okay. I was hoping it'd be bigger. Okay, look. No, that's not good. That's not really telling you what the cycle is, though. Let's find a better cycle. Well, that's probably a good one. I like that. All right, good. All right. Standard business cycle. This is not something somebody made up one time. This has been going on. I learned this when I was in school. It's like 30 years ago I was in school learning this stuff. This has been going on for hundreds of years. You have a contraction. Financials start falling apart. Consumer cyclicals. These are the late stage things when you're in a contraction. Remember how in 2008 the banks went up and up and up and then the whole thing blew up, right? So people start going into these things. What happens? You have property. GDP increases. Yes, that happened in 2007-8. Property values start falling. That's the indication that the commodity prices. Remember oil collapsed in 2008? So oil collapsed. Then the property values fall. Then there's a recession. Then bond prices went up. Then inflation goes down. This is what happens. The economy breathes in and it breathes out, and it goes up and it goes down, and that's normal. There's really no way around it, okay? Joseph and the Pharaoh. He was telling the Pharaoh there will be 7 years of good, and 7 years of plenty, and 7 years of famine. And if you don't put your money away in the 7 good years, you're going to be screwed when the famine comes. Hey, he was the first economist. This has been going on since then. Then you come back. Short-term rates fall because inflation falls. Short-term rates fall. The economy's weak. Then stock prices come back because the short-term rates are falling. Then you're in a recovery. Then the economy begins overheating. Then bond prices fall, but commodity prices shoot up again. Then inflation rises. Then short-term rates start coming back. Here's the part we skipped, though. We skipped this part. We never rose the rates again. We just let everything rise and rise. The inflation didn't rise, and it's because of the nature, because usually the short-term rates benefit the people at the bottom. In this case, all the money really went to the richest people. But then you see the things come back. Transportation came back, technology, services, including healthcare services, by the way, capital goods, basic materials never came back because of this. We never did it properly. And basic materials haven't been part of this rally. Energy hasn't been part of the rally because we never stimulated the bottom of the economy. And by failing to stimulate the bottom part of the economy, we've left a giant hole in all this. And it can collapse very, very quickly back down, much more so than normal. And it's because, and I get on about it all the time, and people think I'm a communist, but it's because we are losing the bottom 80% people. They've got no freaking money because we treat them like crap, because we're greedy bastards at the top, and everything's about corporate profits, and corporate profits means you're taking the money away from the workers. There's no two ways about it, okay? Let's see. Wages, corporate profits. Again, this is not a complicated concept at all, and it's got nothing to do with Republicans and Democrats. Corporate profits versus wages as a percentage of GDP. Once upon a time, wages were half of the GDP, and corporate profits were half of the GDP. But since 2000, this is just in 15 years, corporate profits are now 52% of the GDP, and wages are 44% of the GDP. 6%. In order for corporations to take 2% more, because they're much bigger than wages, because think of that, corporate profits are way bigger than the wages they pay. So in order for them to get 2% more profit, they had to take 6% of the wages. And you as an investor expect your corporations to make 2% more profits, right? You want them to go higher. You don't want them to go lower. And the more they take, where are they going to take it from? Half the GDP. Okay, when they take more, when they go from here to here, these guys go from here to there. Oh, I'm sorry, it's a different scale on this side, but here it's actually even. So it's from 9 to 14 is 5%. So 9 to 13 is 4%. Here's 4% here, and that costs 5% here. That's how it works. Here's 49. So here's 49. They go down 5%. They go up 4%. So it's pretty even between corporate profits and wages. But the point is, there's nowhere else to take it. They're going to take it from labor. There's no magical genie that makes more GDP or whatever. It doesn't grow that fast. They're taking a bigger and bigger percentage of GDP and leaving less and less money for the workers. And the workers have no disposable income. Look at this crap. Look what happened between 2000 and here. This has been going on for years and years and years. It's not a new thing. It's just getting worse and worse and worse. That's all. Every chart you look at, corporate profits go up, wages go down. That means the people who buy your stuff have no money. You took it from them already. You can't keep taking it and expect nothing to happen. Okay? And that's why you get these weird recoveries where it doesn't work properly, because you don't have anybody to buy the energy. See, things corporations can buy, like new robots to replace the workers, things the corporation can buy, they'll do well because companies can afford it, because they're making record profits. So anything they can do to make more profits and do this or that is great. So hotels do well because they can go on business trips. Airlines do well. Car companies do well because all the executives can buy cars. Don't forget, we only sell, as much as they're talking about an auto boom, it's still only 17 million cars a year. Okay? We have 160 million workers in this country, and we sell 17 million cars a year. So 10% of the workers bought a car. This is really not a number you should be partying about. It's 10% of the working people in America bought a car. That means they're replacing their cars at a rate of once every 10 years. That is not an exciting number. It's just better than the crappy number we used to have. So you have 10% of the workers get a new car. That's the top 10%, or the top 20%. But realistically, obviously every worker kills himself to afford a car that can possibly do it. So pretty much all of them have cars, cheap cars, whatever kind of cars. That's driving your auto sales. But when you get into, those are necessities. So things like cars are going to do well in any kind of economy that's not completely falling apart. But when you look at like luxury vacation homes, those are going to do well because the top 10% can totally afford it. Anything that the top 15 million people can afford, like a GoPro camera, right? 15 million people can buy a GoPro camera for $300, and GoPro is going to make $300 million because that's only selling 1 million people a $300 camera. So they're going to get $300 million. They'll probably get $1 billion because they'll sell 20% of the people a $300 camera who can afford it. That's why, look, I'm in that business, right? I sell memberships to rich people. I sell memberships to people in the top 10% who can afford it. I don't try to sell things to the people in the bottom 90%. They don't have any money. It's not worth it. They don't have any money to invest anyway. But they don't have any money to buy newsletters and do frivolous things. They don't have any money to invest. They don't have any money to spend on newsletter services. I service the top 10%. I'm in a great position. This is where you want to be in the economy. Figure out ways to service people in the top 10%. The people in the bottom 80% have no money. People in the 80 to 90% range, you know who they are. They're the people who work for you. They got money, but not a lot. They're okay, they're fine, they're happy enough. But when you get below that level, when you get down to the vast bulk of the people in this country, they are really, really struggling. And they're struggling so much that they can't afford stuff. And that's what's happening to the economy. It's a really simple concept. And the only way to make it work is to force the top 1% people and corporations to give up some of their profits. They have to accept the fact that they have to pay their workers more money. And that's what minimum wage is all about. You have to force them to do it. They're not going to do it willingly. Okay, you have to pay the workers more money so that they have money and they can put it back in the economy and they can afford to buy stuff. And for those of you who make a living selling stuff to poor people, not poor people, selling stuff to people who are below the top 10%, anybody in that position should be dying for the minimum wage to go up. You want all wages to go up because then people can afford the crap you're selling. That's what makes an economy function. And we're so far away, we've so lost sight of these things, these real basic economic things. I don't understand what the hell happened that nobody understands how economies work anymore. People talk about how you grow the pie. You do not grow the pie by making rich people richer. You grow the pie by making poor people richer. And then the pie gets bigger. The pie never gets bigger when rich people get richer. They just take more of the pie. It doesn't grow the pie. All right, so where are we? What do you view of IBBs? Is healthy credit? Biotech's really high priced. Look, it's not that on sale for one thing. It went up from 175 to 400. That's more than double in 2 years. So do you think that's normal? And in fact, that thing that just happened with that hedge fund guy who tried to raise the price of the drugs, they're now looking into this is what happens with all of them. And long term, I just don't think it's going to last. I don't think these valuations will hold up. I don't think in the long term that they're going to get away with this kind of pricing models that they use right now. I think they're going to start getting more and more regulated. So long term, I'm not a big fan of biotech in general. It doesn't mean I don't think Gilead or somebody like that is a great company. There's plenty of companies that make a huge range of drugs and products that have good stuff and will do well. There's plenty of biotech companies that will do well, but I would rather pick and choose than sit there and say the entire index, because a lot of these companies are being fueled by speculation that they'll have the next big blockbuster and they'll be able to charge $10,000 a pill for these things. That can't last. It won't last, okay? If you get a Democratic Congress, it's going to be over. So until there's Democratic Congress, then you can keep playing IBB. But as soon as the Democrats get in, they're going to start looking at this a lot more closely, and they're going to start looking at it like saying, there has to be some kind of pricing regulation on these guys. You can't charge people. And the logic is incredible, because the logic of charging $10,000 for a pill is they say, well, we make a pill that people really, really need. And so the benefit to them in the months of life that we provide by giving them this pill is much higher than any other pill on the market. And, really that's the kind of logic that if somebody was able to suck all the air out of the atmosphere and then sell it to people like a gulp at a time, they could use that same logic and say, well, people really, really need air, and we have all of it. And we have a patent on air now because we took all the rest of it out of the environment. There's no law against taking air out of the environment. If somebody figures out how to do it, they'll do it. And then they'll charge you for it. They're doing it with, they're doing it with water now. And you know what step one is? The funny thing is, step one is poisoning the resource. And that's what fracking is all about. Fracking poisons all the wells. So first they destroy the water supply, then they start selling you water. It's really an interesting thing. And I don't want to get into that either because it's a conspiracy sort of thing. But honestly, if you look at who's buying all the water resources in this country, it's the same people who currently own all the oil resources. They're moving into water. So that when the oil scam is over, they're going to be on the water scam and they're going to start selling water for huge amounts of money. So that's the game. It doesn't matter what they're selling. They just know that if they sell something people can't live without, they can charge whatever they want and make a fortune. And that's what the biotechs are doing now. But eventually, people are going to get pissed. Eventually they're going to change these rules, and they're not going to allow this kind of stuff. There's a lot of these places, there's a lot of spots where excess profits are just ridiculous. And yes, you can argue R&D, and it takes time, and there's so many misses, and blah, 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 whatever. But look, that's the gamble you take when you fund one of these small biotech companies. You're paying for that R&D. Okay, it's the lobbyists for the big biotech, for the bigger biotech companies are going to say, oh, well, we fund all these different R&D projects. And the answer should be, well, stop funding so many R&D projects. You're spending way too much money on R&D, and let the small companies do it. Let other people have a chance to develop things. Because if you're that inefficient at R&D that by the time you actually come up with a pill, you have to charge $10,000 a dose, then you probably didn't do a real good job developing. And yeah, regulations, there's a million arguments back and forth. You can talk about regulations, talk about all kinds of stuff. It all needs to be addressed at some point. And it all will be addressed at some point, because you can't have 20% of your country's GDP going into healthcare. And that's what we're hitting now. We're hitting 20% of our GDP is healthcare. That is nuts. And that's going to stop. It's going to stop because it has to stop. Again, this goes back to the physics of the thing. It's going to stop because it has to stop. Because healthcare is eating into everybody else's profits. Because again, giving healthcare more and more money doesn't grow the pie. And it doesn't make people live longer either, for that matter. It just gives them more money. The only thing you accomplish is giving them more money. And even the other corporations are starting to get upset about what's going on in the healthcare sector. And that's how come Obamacare passed in the first place. It's step one towards regulating this stuff and getting it under control. And there's enough people who wanted it to go through, who are powerful, that even the incredibly powerful people who tried to stop Obamacare couldn't do it. And that goes, and in every other country. I mean, we're the only, we spend double what every other country spends on healthcare. We're the only country that spends this much money on healthcare by a mile. It's not even close. And we don't get better outcomes. So is it not going to change? It makes America uncompetitive. If you want to boost the economy, everybody talks about how cheaper oil boosts the economy. Cheaper oil won't boost the economy as much as paying half as much money for health care. Okay, a person buys per car 750 gallons worth of gas a year. That takes you 15,000 miles, 20 miles a gallon. So a person buys around 750 gallons of gas a year. If they save $2, that's $1,500 in their pocket, right? How much do you spend on health care a year compared to gasoline? If you can save half the money you spend on health care, then you're going to be in way, way better shape. And the economy will be in way, way better shape. And it's going to be permanent and lasting. The only thing is, the healthcare part of the economy won't be in better shape. But long range, that's what you're looking at. So it's not as you can see, we don't have any biotechs in our long-term portfolio. It's not something we really go for. Because I think that sector is just, it's just not going to last. You can't, the party is over at this point. They got too big, too greedy, and they're hitting a limit where you can't afford to fund this anymore. And by the way, if you want to save half your money on healthcare, go to any other country. Go to Mexico, go to Canada, move anywhere outside of the United States, and you will spend half as much on healthcare. So if you're currently spending, $2,000 a month or something like that for a family, if you're currently spending $24,000 a year for healthcare, and you want to make $12,000 a year, so if you think about it, if you have an extra $12,000 a year, basically you move to another country and half your house is paid for. You get a mortgage for $2,000 a month. Half your mortgage is paid for just by what you save on healthcare by getting out of this country. That's how crazy it is. So why people want to come into this country is the weird thing. Because it certainly wouldn't. I imagine they'd be pretty shocked when they find out what it really costs to be here. Does DAX affect comp more or SPX in terms of percent? DAX is going to affect the S&P as far as that, but it doesn't affect. The DAX is an indicator that shows the mood of people in Europe, basically. The best thing to do is basically the mood of the market in Europe is what the DAX is. It's like the S&P for Europe. That's what it is. So it doesn't directly affect the S&P, but if people in Europe aren't in a good mood, then people in America probably aren't going to be in a good mood either. We're the same globe these days. What are my thoughts on bonds? I I think anybody who gives the government money to hold for 10 years for 2% is an idiot. So that's my thought on bonds. That's ridiculous. Inflation is also artificially held down at the moment. So is there a short in our IBB? No, I just stay away from it. It's not a sector I would invest in. I would have shorted them at 400 if I bothered, but again, it's not a sector I have any interest in. If they get down to 200, I would go long. I mean, that's basically where I think they should be. It's about half of where they were. Any reasonable way, but I wouldn't bet on shorting them because you never know what's going to happen for sure. Any reasonable way to hedge a muni bond portfolio against inevitable rate increases? Geez. Yeah, well, you can short TLT. Oh, yeah, I'm not free. How's 2016 going to look for the market? I flat. 2016 will be flat. Let's get back to this TLT thing, though, just to give you an example. But again, I would short bonds by not having any. I mean, I would hedge bonds by not having any. The bonds are just, unless you have, if you have tens of millions of dollars, you kind of have to have some bonds. But generally, I'd so much rather have like good, solid dividend-paying stocks with a well-hedged or something like that. Because really, I mean, what the hell? You're going to let them hold your money for like no % interest, and then you have to insure it against damage? That's ridiculous. 130 is where we short TLT. So we automatically short them at 130 because that's what I consider the highest it should ever be. I mean, yeah, it doesn't stop it from spiking higher, but on the whole, it's been a pretty good rule of thumb to short them around 130. You're worried about it going down lower. So if you're worried about your bonds dropping, 10% in value or whatever, and TLT is going to go down probably to like about 110, 100 in that range, then it's very simple to take a short position, and you don't want to take one that's too damaging. But the problem is the cost is ridiculous compared to what you're getting. Because if you got, there's TLT. So, if you got $1 million in bonds and you're worried about losing $100,000, how do you hedge $100,000 with TLT? Well, you probably want to take, let's say we took the 125s for 13. I'm just going quick rounding here. So the 125s here for 13 puts, and you sell the, and this is only 2017, doesn't even go out that far. Then you sell the 115s. No, let's say sell the 120s. So these are 10. So we said, what do they say? 13 and 10. So it's $3 for the 125, 113 bear put spread. So if TLT goes down below 125, and it's already partly below, you will get up to $5, okay? Now, you can offset that price. Now, if you get your 2% on your bonds, you're going to get, what are you going to get, $20,000 or whatever it works out to. Yeah, you're going to get $20,000. It's so ridiculous how we can do it. $1 million to get $20,000. Why would you do this? So you can sell like the 145 calls. And the 140, so in other words, you're going to sell because you're going to say, and all you're doing when you're selling the 145 calls, you're saying, I don't think rates are going to go negative by that much. Because the rates would have to be severely negative for you to get into this. You'd be here below 0%. So if you think that the rates will stay positive on 20-year notes, you can sell these 145 calls for $2. That offsets $2 out of $3 of the cost of the 125, 120 bear put spread. So now you're in it for $1 and you're in the money. So now you're going to make $4 if TLT goes down. So now the question is, how much of that do you need to offset your expected loss of $20,000? You need 50 of those contracts. And the 50 contracts, if you short these 50 over here, you'll have 50 of these will credit you $10,000, and these will cost you $15,000. No, yes, it's $3 a contract. So these are costing 15. So you'll be net $5,000 in that position, and that position will pay you $25,000 if it goes down. So maybe you need 100 and you get $50,000. You won't hedge the whole thing. So meanwhile, though, look at what you have to go through just to hedge a potential loss. I mean, why have them at all? I don't get the real concept of why you want to have bonds. It's just such a terrible, terrible way to move your money around. You know, and again, if you've got millions and millions of dollars, you have to deal with it. But it's yeah, that's what Steve's right. So just don't be in bonds. There's just definitely better ways to do it. It just costs so much money to hedge it. If you're going to get into a bond, you really should be only in the bonds because you're hedging against. What the hell would you be hedging against? I mean, I don't get the. You're not hedging against anything. And bond doesn't help you. All you're doing is see. In the old days, the bond used to be a hedge against a market collapse, and then the market would collapse. And what would happen in a market collapse? In a market collapse, interest rates would go down, and then your bonds would go up in value because your bonds would be paying a higher rate than the new bonds. That was why you used to get bonds. Okay? 20 years ago, that's how it used to work. Bonds would become more valuable because your 5% bond, when the market crashed, would be higher than the new interest, or your 8% bond when the market crashed would be higher than the new interest rate of 5%. So then your bonds would get a 30% bonus because they're paying a higher rate of interest over 10 years. 3% more over 10 years is 30%. That's what used to make bonds a hedge against stocks. Okay? But when you're starting out at 2%, you don't have a hedge anymore. Unless bonds go to 0% and stay that way, then you don't have a hedge because they're not going to become more valuable. And you know what? If bonds are at 0% in the future because of whatever market conditions cause that to happen and it sustains itself, you've got way, way worse problems than whether or not your bonds are worth anything. It means everything's falling apart again and collapsing. So no, so that's the problem with bonds. I mean, bonds are a very old school thing. And yes, most of the brokers are old. Most of your financial advisors are old, and they tell you stupid things like that. Okay, because they're old and they know old stuff. All right, so you have an existing $10 million portfolio paying 4.75% tax-free. All right, see, when you have that much money, then when you get into millions, then you might want to have some bonds. So you have $10 million of bonds at 4.75%? I mean, it's nice tax-free, but honestly, it's not that much money. I mean, I could certainly show you dividend plays that are way, way better than that. Who would we talk about? Let's look at NLY, which is a big REIT. Okay, here's a good lesson for everybody. Okay, so let's talk about that instead of a bond. So NLY is a mortgage REIT. They're down at $10, and let's take a look at their chart. And let's take for granted. I mean, this is one of our favorites, so we'll just let you. I mean, so take for granted they're a decent company. No growth, but of course they're not going to have any growth because they pay out all their profits in dividends. So companies like this are not going to have growth because they're paying out everything in dividends. If we go to Yahoo and we look at NLY, $7.99%. Okay. Now we look at options. No, not options. Sorry. We're going to look at the dividends and how they pay it. So they pay 30 cents 4 times a year. They used to pay more. They used to pay less. See here they paid less. In 2006 and 2007 they paid less. Then they paid more. And now it's kind of calmed down a bit and they're down at 30. But they distribute 90% of their profits as dividends. That's what they do as a charter. So when they have good years they pay more. When they have bad years they pay less. Currently they're paying 30 cents per quarter, and it's been pretty steady, and the company's in good shape, so it's a nice thing to own. Now, you don't just buy the stock, though, but what you do is you buy the stock for $10.18, you sell the $10 puts, let's go to 2018. That'll be much better. I like this better. All right, need my calculator now. All right, now I'm going to write this down, and then we'll get back to it. All right, so it's 10.18 for the stock, 10.18 for the stock. You promise to buy more stock if it gets cheaper. So you're going to sell the $10 puts here for $2.17. So it's 2.17 for the $10 puts, and you're going to sell. Can't sell those for 8, so I have to sell the $10 calls for 65. No, that's not right because this thing's gone. This doesn't make sense. Let's call it somewhere between 54 and 96. Let's call that 75. So it's 75 for the $10 calls. All right. So what you're doing now is you say, I'll buy the stock for 10.18. I'm going to sell the puts for 2.17, and I'm going to sell the calls for 0.75. So you're going to net into this position for $7.26. All right? Now, if it's assigned to you, in other words, if NOI is below $10 in 2018, you'll be assigned another round at $10. That'll make your average, so it's plus 10 divided by 2, is 8.63. So your average entry would be 8.63 if you get assigned the whole batch, right? Now, on your $10 million at 4%, you're making $45,000 a year, right? NLY pays a, how much dividend? About 20, I think. Yeah. So they're going to pay me $240. They're going to pay me $240 per contract. How many contracts do I need? So we got 90,000. And by the way, I'm not saying you should do all $90,000 here, but let's divide it by 240. 375. I need 375 contracts. So I'm not going to do that though. What I'm going to do is I'm going to go 200 contracts, and I'm going to show you how it works. So now we're going to take the net. Oh, I can write it down. Damn it. All right. 1018 minus 217 minus 0.75 is 726. Now I'm going to write it down. 726. Okay. So I'm going to take 200 contracts, which is 20,000 shares. So times 20,000 shares is $145,000. Okay? Oh, wait. Did I do this wrong? I did, didn't I? Because it's 400,000. I apologize. It's $450,000. So we have to multiply that by another 10. So it's 7.26 times, you need 200,000 shares. $1.452 million, okay? So you buy $1.452 million worth, and again, not this stock. I'm talking about diversifying and doing like 5 or 10 of these different dividend plays. But they'd all be roughly the same math. So you're taking $1.452 million of your $10 million and putting it in this trade. You're obligated to buy another $2 million worth if you'll have to buy 200,000 more shares if they go below $10 and stay below $10 into 2018. Meanwhile, though, during this time period, you're going to collect, because you have the 200,000 shares, you're going to collect $1.20 times 200,000 each year. So that's 200,000, I know what that is, times 1.20 is it's $240,000 a year in dividends. Also, though, don't forget your net entry on the stock is 726. So if you get called away at the end at $10 minus 7.26 is 274 times 200,000 is another 548,000. So 548,000 plus over 2 years, $240,000 No, I'm sorry, $480,000. Plus $480,000 over 2 years, you'll collect basically $1 million. That's twice as much money as you're currently getting, yet you're only putting $1.4 million to work with a promise on hold to put $2 more million to work if the stocks go lower. But either way, even in a catastrophe, you're only going to be 30% invested out of your $10 million in the worst case scenario. Yet you're going to get double the rate of return you're getting while you still have $700,000 in cash, $7 million in cash sitting on the side. All right? So I hope that's enough to pique your interest into looking into this concept. Let's put it that way. As all I'm trying to do is trying to say there are other ways to invest the money than sticking into bonds where it dies. All right, so yeah, so carry on this conversation in chat or whatever, because it's a terrible thing. Any of you guys who are doing this with bonds, it's a terrible waste of money. It breaks my heart when I talk to people who do things like this. And these are long-term capital gains, so the tax amount is negligible. And there's 25% right now. So long-term capital gains. So basically, you're going to clear 7.5% or whatever after taxes, and that's obviously then you got other deductions or whatever you can do with these things. It really, and again, but again, the key to it is you still have $7 million left on the side. That's a big deal. You can make money with the $7 million, right? It's not dead money. Invest in a business, build something. Put it into other stuff, buy other stocks, get some IBM, things like that. We always find stocks to buy. It's that flexibility that you lack when you stick your money in a bond, and then God forbid the bonds go down, which they will if rates start rising. If those bonds start losing value, or if they default, anything in 4.75% has certainly got a default risk. And even so, and also you're asking about hedging it. Your hedge is an expense too. That's going to knock off, because if you spend $100,000 on the hedges, you knock your rate down to 3.75. This one's already hedged. So that's what you do with money. And honestly, there's so many better things to do with like millions of dollars and do that. I mean, there's so many businesses to invest in. And that's, again, I would own some brick and mortar businesses if you don't. I mean, that's also a very, very good thing to do, is to own actual things that make money. All right, anyway, so that's a good place to leave off. If there's no more questions, it's 2:30 already. Holy cow, does time fly. On the whole, getting back to the markets one more time, we're holding up okay. This is why we're not, this is why we're just watching and waiting. We want to see what happens. The S&P is struggling to get back over. Draghi didn't kill us. Now we got the Fed minutes to look forward to. We have the Bank of Japan tomorrow morning is going to make some kind of decision. I don't think they're going to do anything either, because, again, everybody's already stimulated the crap out of their economy, and it's not enough because it's the wrong kind of stimulus. Until they start stimulating the actual workers and putting more money into the people who are not spending money, the consumer class, it's never going to work. And it's, you're very fooled because you see these companies doing great that are servicing the top 10%. When you see Best Buy doing good or Apple's doing good or whatever, it's not for poor people. You forget about that. But if you look at, in fact, movies there's an interesting thing about movies. Movie ticket prices have skyrocketed, and popcorn prices have skyrocketed. Everything, all the snacks you buy at the movies are crazy prices too. Attendance for movies is down, but money for movies is up because they just charge more money, because the people who can afford it, it only takes, a blockbuster movie is what, $100 million is a blockbuster movie, right? That's considered a fantastic movie, and maybe in the course of a 52-week year, maybe there's like 20 of them or 30 of them that hit that number, right? How much is a ticket? Ticket's more than $10, right? That means only 10 million people in the entire country out of 300 million people go to see a blockbuster movie for $100 million. So, I understand some of them get 300 million, 400 million. But basically, again, the top 10% of 150 million workers is 15 million people, and we all have families. So we go with our family, that's 45 million people, 60 million people that can afford to go see a movie. 60 million people can afford to go to the movies easily. I mean easily. Like you don't sit there and go, oh, a movie, I don't know if I can afford that. But everybody else, they worry if they can afford it. People in the bottom 80% can't afford to spend $15 a ticket and $10 on popcorn and $5 on sodas. That's just a no, they don't go. And that's what's happening. So the movies are full of rich people. It's not a thing poor people do for entertainment anymore. Poor people stay home and watch Hulu or Netflix. And that's good for them. It's not so good for the movies, but the movies figured out that they can just charge rich people more money. That's what this economy is turning into. It's a very, that class line is so sharp in this country between the upper class and the lower class. There's no middle class anymore. There's upper class and lower class. And the line between them is so sharp now that there's just totally different businesses that cater to different sides. And it's not a healthy economy, and it's not an economy that can last. And what the Fed has been doing since day one is pumping more and more money into the top part of the economy and nothing into the bottom. And that's just basically all you're doing is recreating everything that went wrong last time. And the only difference is now we don't have this subprime bullshit. The subprime thing was multi-trillion-dollar financial scam that blew up. That's the only reason this economy is healthier than that, is because we don't have that anymore. But now what we have is a lot of overpriced companies that are making everybody feel richer than they should be. And as the earnings come through, if those earnings go bad, the market's going to turn back down. We're going to come back down another 100 points in the S&P, back to 1850. Nothing tragic. I'm not predicting disaster. I'm just saying we're going to get to more of a realistic pricing. And at some point, the company's going to have to prove that they can go out and make a market. And they can't go out and make a market when their customers are broke. So it's a big problem. It's going to be a big problem now. It's a big problem in 2016. We have to be really careful about where we put our money. Not to say there aren't plenty of places we can put our money, but we just have to be careful and mindful of what we're doing. All right? So thank you, everybody, for coming. I hope that was helpful and entertaining and whatever. And, one more thing. Wait. Yeah, Jim says I want to pay. I agree. I mean, as a parent, I go, but I frankly don't go to the movies very often because it's the same problem with Broadway. I see the Broadway play. It's $100 whatever a ticket, $150 a ticket, or whatever the hell it is. I go with my wife and kids, and I got $1,000. And by the time you have dinner and go to a show, it's $1,000 night out to go see a Broadway show. There is no dancing in the world that is going to be worth it. I can't help it. I can afford it, but I sit there and I look at the freaking show, and I'm looking at the show, and I'm sitting there. I'm like $1,000, man. We could have been we could have gone to Florida and see my mom. We could have gone somewhere else. We could have gone to the Bahamas for the weekend. I'm like, I'm doing this instead of going to the Bahamas for the weekend. That is stupid. And when I go to a movie, it's the same thing. Because I go to a movie, but it's the same problem though, because Broadway has realized that poor people can't afford it anymore, so they double the price for the rich people who can afford it. They have less attendance, but they make more money. And movies are like that too. They have less attendance, but they make more money. So now it costs the same thing. If I go out to dinner, if I go out for a reasonable dinner and the movies with my kids and my wife, it's $100 minimum for the night. How can regular people afford that? That's crazy. $100 is a lot of money. Anyway. So that's what's wrong with society. We need to fix it, and I don't know, vote for Bernie. Maybe that'll work. How's 2016 going to look for the market? It's going to be a flat year. I think it's going to be a struggle because, again, you have to align all these different things. Have to line up, and you have to reimagine the economy to either we're going to end up accepting it. Look, believe me, if we don't change politically, we're going to have to accept the way things are, and we're going to have to. Again, if you have businesses, make sure your businesses cater to either necessities that the bottom 80% have to buy, don't have a choice that they have to buy, or you cater to things that rich people can afford, or not can afford, that rich people want. Doesn't matter if they can afford. I mean, rich people can afford it. So people in the top 10%. So a company, so when you get a company like Tesla, who says they're going to make $80,000 cars and sell millions of them. You know they're full of crap. There's not millions of people who are going to buy $80,000 cars. So then their next story is that they're going to make $35,000 cars, but then you look at the technology and where we are now with battery technology and everything else, you say that's not possible either. They can't make a $35,000 Tesla. They can make a $35,000 electric car because Chevy does it with a Volt and whatever, and Toyota does it. You can make a $35,000 electric car, but it ain't going to be no Tesla. It's going to be just a regular electric car, which means why on earth would Tesla be able to sell millions of them when they're going to have the same tinny piece of plastic garbage car that everybody else has for $35,000? There's no magic there. You know, Elon Musk has a mystique because he made an $80,000 car, or really $100,000 by the time he actually put stuff in it. But he made an $80,000 car. That's fantastic. It's like, yeah, well, if anybody else bothered making an $80,000 electric car, it was fantastic. And now you're seeing people are doing it. BMW is doing it, Porsche is doing it, other people are coming out with electric cars. They also look totally cool and fantastic because when that's your budget, that's totally different. But it doesn't mean you can take the same car and make it a $35,000 car. That's nonsense. So you have to look for companies that realistically understand their market and are gauging properly for the market. Like I said, GoPro, fantastic, okay? Anybody who wants to sell knickknacks, $100 knickknacks for rich people, that's a great market. Companies, and again, you have to have a realistic target. Your target can't be like, I'm going to sell 1 trillion of them. You're going to sell like the coffee thing, Keurig, right? If you've got money, you see a $100 little pod coffee machine, and you don't do the math on the pods. Your coffee costs you 50% more because you're using the Keurig than if you use regular coffee. But you don't care because it doesn't matter to you. It's not important money. But Keurig, the reason Keurig fell apart is because when you start trying to move past the initial market of the top 10%, all of a sudden you have to have a value proposition, and they don't have a value proposition. They're too expensive. Poor people sit there with a piece of paper, or they know it intuitively, and they say, I cannot afford this item. I can't afford 50 cents for every single pot of coffee I drink, every cup of coffee I drink. So they don't buy it. And the soda machines, too, the same thing. The soda machines are ridiculous. You know, the cost of running them is too much money. Yeah, so you have to think intelligently about what can go. Now, when they start off, they have great growth, so you jump in on these companies early, that's great, but you have to know also to get the hell out after they have a run-up because realistically their business model falls apart. And to understand that, though, you just have to understand the dichotomy of the society that we've created for ourselves, where we have an upper class that has all the money in the world and has no concept of how much things cost and doesn't care what they spend, and then you have everybody else, the pros. And they're struggling every day to make a living. They have no money for retirement. They have no money in the bank. If they get sick, they can go bankrupt. That's their life. Those are not the people who are going to be buying the goods that you're selling. And the only thing you can sell them is necessities. And you have to find, and in that case, you have to look for the companies that make things that are just as good but cheaper, so that poor people can benefit from it. Those kind of people make money. All right. Sorry, I didn't want to be depressing, but that's just the way. It's important to understand the viewpoint because that's how we're going to be discussing our investing premise for next year, which we're going to get much more into in the next few months. All right. Thanks, guys. Have a good day.